Welcome, founders. So if you're gearing up to walk into a boardroom or maybe hop on a Zoom call and pitch your very first business idea to investors, well, you're absolutely in the right place. Today's explainer is really designed as your ultimate defense strategy. We're going to master the financial language that every single investor expects you to speak fluently. Because, it's not just about having a killer product, it's about proving you actually know how to build a real, sustainable business around it. Okay, let's dive into this.
Here's our roadmap for today. Number 1, mastering business finance language. 2, revenue, expenses, and cash. 3, proving your financial health. 4, financing your company's growth. And finally, number 5, the metrics investors actually watch.
Kicking things off with Section 1, Master Business Finance Language, or as I like to call it, the bloodstream of success.
Before you even step foot in that boardroom, a crucial mindset shift needs to happen. Business finance is basically the process of planning, managing, and using money to hit your goals. But let's make it concrete. I want you to think of your new startup like a human body. Your sales, that's the food. Your employees, they're the muscles doing all the heavy lifting. Your products or services are the hands interacting with the world. But finance is the bloodstream. Without healthy cash flowing through the veins of your company, literally every other part of the business eventually just stops working. It really doesn't matter how strong your muscles are if the bloodstream fails.
And because it's the bloodstream, you've got to be ready for the inevitable investor inquisition. They are going to look right across the table at you and ask, so, how much are we making? How much are we spending? Can we actually afford to hire more people? Are we going to have enough cash next month? Having rock-solid answers to these questions isn't just, a nice to have. It determines whether your company grows into a unicorn or just disappears completely before year 2.
Let's move to Section 2 and see how this builds into your operational reality. Because honestly, this is where it gets real.
This operational reality is exactly where so many first-time entrepreneurs completely trip up. There's this massive misconception that high sales automatically equal business success. Let's call this the $20,000 coffee shop illusion. Just imagine you're pitching a coffee shop concept, and you probably tell the VCs you're projecting 20 grand a month in sales. Sounds amazing, right? 20 grand? But any seasoned investor is going to look right past that top-line number instantly.
Because they're waiting for this exact breakdown. They want to see the expenses eating away at all that glorious revenue. Think about it. You've got $8,000 going to rent for that prime location, another $6,000 to employee wages, $4,000 for the coffee beans and ingredients, $1,500 on utilities, and maybe $700 on marketing. When you add all that up, your total expenses actually come out to $20,200.
Which brings us to a pretty stark reality, negative $200. So the crucial point is that despite making 20 grand in sales, your business is actually losing money. Revenue is simply the money your business earns from selling your products. Profit is what's actually left over after paying all your expenses. And listen, if your expenses grow faster than your revenue, you are going to fail, no matter how incredible those sales numbers look on your pitch deck.
Now, to keep those expenses lower than your revenue, you have to prove to an investor that you understand exactly how your costs behave. You need to show them the difference between your fixed expenses, things like rent, insurance, and salaries, which stay exactly the same no matter how much you sell, and your variable expenses, like raw materials, packaging, and shipping, which fluctuate depending on how much you produce. When an investor sees you clearly categorizing these, it proves you can predict your costs and, more importantly, intelligently plan for real growth.
But wait, here's a massive trap that investors are absolutely going to look for, and it surprises almost every new entrepreneur. Let this sink in for a second. A profitable company can still go bankrupt. No way, right? How is it even possible that your revenue is higher than your expenses, you're turning a profit, and yet you still have to lock the doors for good? The answer is cash flow. Cash flow measures when money actually enters and leaves your business. Say you sell $100,000 worth of custom furniture to a massive hotel chain. That is a highly profitable sale, but the hotel's terms dictate they're going to pay you in 90 days. So on paper, you're profitable today. But today, your employees need to be paid. Your rent is due today. Your suppliers need their checks right now. If you don't have enough actual cash in the bank to survive those 90 days, that profitable sale on paper will literally ruin your business. That is why cash flow is what actually keeps your business alive.
All right, moving right into Section 3, proving your financial health, which is basically the due diligence breakdown.
This is the phase of the pitch where investors want to look under the hood. They are rigorously evaluating what creates value versus what drains it. On one side, we have your assets. This is the value your business actually owns: your cash, equipment, inventory, intellectual property like patents, and even money customers still owe you. On the flip side, we have liabilities. This is the money your business owes to others: loans, supplier invoices, taxes, and unpaid wages. It's really this simple. A fundamentally healthy company generally owns more valuable assets than it owes in liabilities.
To prove that health, you absolutely need to prepare the golden trio of financial reports for your data room. Step 1 is your income statement. This answers one straightforward question. Did the business actually make money over a specific period? It shows your revenue, expenses, and profit. Step 2 is the balance sheet. Think of this as a financial snapshot frozen in time, showing exactly what you own, what you owe, and what's left for you, the owners. And step 3 is the cash flow statement. This report tracks exactly where real cash came from and where it went. Together, these 3 statements tell the complete, undeniable financial story of your business.
And this brilliantly illustrates one of the absolutely crucial concepts you'll discuss: working capital. You calculate it by taking your current assets and subtracting your current liabilities. If this number is positive, great, you have enough short-term resources to pay your upcoming bills. It's kind of like having fuel in your car. You could have a gorgeous car and a perfect map to a beautiful long-term destination, but it doesn't matter at all if your fuel tank is empty today. Without working capital, your long-term promises mean absolutely nothing to an investor.
Section 4. Financing your company's growth. It's time for the Ask strategy.
We've arrived at the climax of your pitch, the exact moment you ask for the capital to grow. As a founder, you generally have 2 main paths, and you have to explain to potential investors why you're choosing the route you're on. Path 1 is debt financing. This basically means taking out loans. The massive advantage here, you keep full ownership of your company, the whole shebang. The downside, though, is you have to repay it with interest, which puts pressure on that monthly cash flow we just talked about. Path 2 is equity financing. This is where you bring in VCs or angel investors. They give you cash in exchange for a piece of ownership. The advantage is there are no stressful, immediate monthly repayments. The downside, you are giving up a slice of your company and a share of all its future profits. Choosing between these isn't about right or wrong. It's a highly strategic choice based on your specific goals, your risk tolerance, and your current stage of growth.
Finally, Section 5, the metrics investors watch. Let's learn how to speak their language.
Let's look at the final analytical tools investors use to judge your pitch. You have to remember, investors look at hundreds of pitches. For numbers to actually mean anything to them, they have to be comparable. That's why they rely on essential financial ratios, things like the profit margin, the current ratio, and the return on investment, or ROI. These ratios allow an investor to compare your tiny startup to a massive, established corporation, or even to another startup in a totally different industry, so they can quickly pinpoint your financial strengths and weaknesses.
Take the profit margin ratio, for instance. You might have massive revenue, but this ratio reveals exactly how much actual profit remains from every single dollar of that revenue. If your revenue is $1, does 10 cents drop to the bottom line, or does just 2 cents? By presenting these ratios confidently during your pitch, you show investors you aren't just winging it. You actually know the precise mechanics of your money-making machine.
Which brings us to our final ultimate question for you as a founder. Are you relying on guesswork, or are you truly ready to speak the language of every successful business? Look, finance isn't just for accountants. It is the core of literally every single decision you are going to make, from hiring your very first employee to launching your first product. Mastering these principles is about surviving that pitch, securing the capital you need, and building a foundation that ensures long-term growth. When you learn to speak this language, you stop just pitching a cool idea, and you start presenting a truly undeniable business. Thanks so much for joining me on this explainer. Now get out there, go practice that pitch, and I'll catch you next time.